Let's also welcome on board then Vikas Khemani and talk about what his take on the markets is currently. Vikas, hi, afternoon. Good to have you in the show as always. It's turning out to be quite an irritant, Vikas. The way the market on a daily basis has been reacting to each and every move on the US bond yields and how the global markets are moving along with it.
It's great to be on the show. You're right that interest rates, rising interest rate or the hardening of the interest rate in US and in India has been a concern, but that's bound to happen. Also, we have had a steep sort of rise in the markets across the board over the last 5-6 months. So whenever this kind of rally happens, obviously markets are bound to get consolidated. And the question most people would have in the mind that what from here now? Are we going to see some sort of slow growth? Are we going to see some sort of impact on the inflation? Commodity prices are going up. So all those things are genuine sort of concerns, and that's what sort of makes market bit sort of consolidated. Otherwise, you can always kind of keep extrapolating and market will be one way up. So this kind of environment or news flows is good. There's no doubt on that. But I don't think this is something to structurally derail any of the economic recovery cycle. What India is going through, India is kind of going through a significant catalytic moment in terms of manufacturing, in terms of IT services growth, in terms of overall consumption profile, investment cycle. So we have fairly large enablers of the growth for Indian economy, and that's what makes it a very unique and interesting place to be. And if you are looking markets from a 3 to 5 year perspective, you should sort of look at these kind of consolidation phase to kind of make investments. So that's how I think it. And having said that, one cannot wish away risk. Every market would have risk, and this also has risk. And we have to be careful. One cannot just say that look at long term and short term, just ignore. I mean, it's never the point. So you have to manage your risk. You have to take into account lots of factors which are developing. But currently at this point in time, we are not overly concerned about some of the development you mentioned.
Sure. Because the other debate in the market is that while growth has done well for the last 5 to 7 years, it's value which is finding value in the market right now. Where is it that you stand within this debate? And do you think it's time for value to actually emerge a winner as opposed to growth stocks?
Every investor has its own style. Every sort of there's a market cycle and there's a sort of rotation which keeps on happening. I have been a firm believer that in India kind of market you always will make money, or large part of the money will get made out of growth. Only when earnings growth, only when cash flows are made, you create sustainable value for in the equity market. Having said that, there will always be sort of times when, let's say recently what happened to PSU banks. You saw a significant rally. Can you find a lot of value there? Answer is yes. But if you keep on chasing or keep on switching your style from growth to value, you will never be a successful investor. So I think idea is to stick to your core, what you believe in, and stick to that. There will be periods when you will not do well, or some other style might do well, and there will be periods when your style will do well. But what I inherently believe that sustainable long-term wealth creation or above average wealth creation happens when you are looking at growth investing. And of course, I mean, we don't believe that growth at any price is the best way to go. But so you have your own style. Everybody has their own style, and we firmly remain footed into our style of finding sort of good companies with a robust sustainable growth profile, and where possibility of re-rating is also in offing. That kind of drives you with significant returns.
EV ready, that seems to be the new buzzword, Vikas, when it comes to Motown. And a lot of companies have indicated their intent to be EV ready in the near future as well. Where within the entire auto pack do you still find value? Because, from last year, March, when the pandemic did hit, we saw first a recovery coming into ancillaries, and that's largely the battery makers, a lot of pent-up demand as well at play there. Then it trickled to your rural plays, tractor sales holding up well, your Escorts and M&M saw a recovery. And then very slowly now it's spread across passenger vehicles as well as CVs too. But do you believe that this is a theme which is here to stay and will, you can find opportunities to buy in afresh even at these levels after the run-up in stocks?
So I think the way we think about is, there was a, deep value that the correction in the cycle happened. So I think to some extent we believe the last part of the auto story from a, deep value perspective has played out. Currently, we find three problems with the whole, auto space. One, we think that, competitive intensity across segments is going up. While I think demand environment can be robust in a medium term or shorter term to medium term. But competitive intensity is going up. Secondly, the commodity prices are sort of going up, and passing on with a high competitive intensity becomes slightly harder. So you might have squeeze on your margin. And thirdly, I think which is very big, and I think most auto companies would be, like you were mentioning, is facing a transition or disruption, whatever you can call it, in form of getting ready for EV market. Now, who will be the winner? We don't know yet. There will be definitely, how the business model will evolve, who will be the winner. So in a situation like this, we will avoid the auto sector per se. We would rather, because India is such a diverse story right now. There are so many other opportunities without possibility of a disruption risk. Rather, you would go and play there than playing auto. In fact, even auto component risk reward is better than auto companies because for the sheer competitive intensity of the marketplace. So the way we feel is that probably your risk reward of investing is better elsewhere than in automobile. Having said that, there are always players like iShares, which is not facing any of these things which we mentioned, and hence probably they could be better off and would be better off. But otherwise, in general, we are not as positive or as bullish on auto sector in general.
Okay, that's the take coming in on autos. Kunal, let's revisit some of the auto names. Tata Motors, the darling of the street of late, and where is that headed? And do you sense that we could see some consolidation or a dip in the stock, or is it going to be a one-way move up?
I think the consolidation has already taken place. Aisha, I think the last 3-4 days, it's been more of a subdued price action for Tata Motors from 350 to 350, 355 to I think 320 or 325, where the stock is trading. So I think it's been a subdued kind of a price action for Tata Motors. But when you look at it in the larger scheme of things, that whether this is a big enough correction to call it probably a reversal for Tata Motors, I think that's quite some distance away. The stock is just about, it goes through those periodic 10, 15, 20 rupees kind of corrections, comes back to some major supports on technicals, whether it's the key moving averages or whether it's price-based supports, etc. And then it goes through a reversal or a continuation pattern on the upside once again. So I think that's been the typical flavor for a stock like Tata Motors. This quarter has been phenomenal for the stock. I think if I'm not wrong, it's already up some 70-75% in this quarter. So I think it's bound to be that the stock maybe over the next few months go through a sideways price action. But I think the kind of moves the stock has shown the last 4-5 months, the breakout, the strong volume participation, I think that's the biggest highlight for a stock like Tata Motors, because you've not seen such a kind of a strong volume participation on quarterly charts. For example, for Tata Motors, I think in the last 10, 12, 13, 15, 13, 14 years for the stock. So that itself tells you that there's been a huge participation. When you typically see a volume burst into a stock, it goes into a multi-time frame upside. So if it's a quarterly chart, you're talking of a possible multi-quarter uptrend for a stock like Tata Motors. So I think it becomes a buy on dips. That's what the end summation is. So I think at 320, 325, it could be a good opportunity for someone who's missed out and wanting to buy earlier at high levels.
Okay. The other theme which is playing out in the market is the oil sensitives. Now, oil and gas firms are the ones which are in focus. You've got uptick in crude clearly playing out, and more importantly, the forecast is that crude prices, elevated ones, are here to stay. So Goldman Sachs, for instance, they've raised their Brent forecast to now $75 to a barrel in the second quarter. They expect Brent crude to reach $80 in the third quarter of 2021 on a calendar year basis, that is. UBS as well, they've raised their Brent forecast to $75 in the first half of 2021 to $72 per barrel in the second half. And look what it's done to some of the OMCs and oil-related companies ONGC, Gail, they've already hit a 52-week high for themselves. The other theme, of course, is PSUs at large. So BEML, for instance. Now, reports are indicating that about 6 companies are looking to buy a 26% stake in BEML, which the government is willing to divest. They include the likes of Tata Motors, M&M, Bharat Forge, Megha Engineering as well. The strategy, of course, is to grow the defense business, cut the dependence on the CV business. Government, remember, owns about 54% stake currently in BEML, and SBI Capital Markets is what we understand the government's advisor on this disinvestment. Vikas, have to get your thoughts in on not just the oil sensitives, but the entire PSU pack at large. The government machinery is chugging along at full pace when it comes to disinvestment/privatization. But for an investor, what's in it for these stocks?
Budget, there was a very clear direction set out on privatization and divestment, and this time the finance minister used the word privatization. It means they are a lot more ready for strategic sale, and they've already kind of on different forums announced their intention to that. So this is a faith which is kind of market is believing in, and there's no question that there's a lot of value in most of the PSUs because they've been incredible businesses with a lot of depreciated value sitting in them. And great franchises, most of them, I would say. So if it were to go in a better management hand or with a lot more freedom and ability to sort of adapt to the changing realities, I think private sector could create a lot more value out there. We have seen how public sector banks have destroyed value over a long period of time. So I think the clear market is sort of taking some comfort with the post-budget that you will see PSUs getting divested, some part of value getting sort of uncovered, or so I think you will see PSUs kind of doing well. Once a full-fledged divestment happens, I think market will reinforce its faith because currently it is only talk and promises. But once I think a couple of divestments are behind, I think a lot more faith will be established in the value because value unlocking will happen only through the divestment program. And so I see, this path going to be a little bit more clear, assuming that the government will make the promise and do, which I believe that, they are on the right course, but it has never happened till it happens. And so this time around, you will see even PSU basket will end up doing well.
But Vikas, the other worry point in the market has been the kind of agri-inflation that you're going to see. The fact that everything from milk, sugar, wheat prices, other essential commodities as well are seeing a spike, and as to how that's going to have a bearing on FMCG companies, because only that much of a window do they have to pass on the fuel price escalation or rather raw material cost escalation onto the consumers. By the end of it, it will either spell into a margin or a volume hit.
There are multiple angles to it. One, I don't think agri price inflation is very large. We've had for a long period of time fairly benign agri inflation. But the point towards your input prices or raw material prices is very valid. It has actually two elements to it. One is the short-term supply chain disruptions, and because of that, many raw material prices have gone up. And second part is that in general, the commodity prices are going up, and because of that, little bit of sustainable commodity prices or input prices going up. So if you see in totality, it may not be very significant at this point in time. Of course, if this continues in this form, some point in time, there will be worry. But my belief is that, in quarter or two, either new capacities will come or, new supply chain disruptions will kind of get sorted out. So you will see some sort of cooling off of the, input prices across the board. And also along with that, as long as there is a reasonably good growth and, there is ability to pass on also increases in a good growth environment. So if the demand remains a little robust, you will have partial pass on also taking place. So I personally feel that it's not as such a big concern at this point in time, but you should always be watchful, careful about, the developments in market because it's never a static point in you have to keep getting data inputs and start assessing. Inflation is one of the biggest markets worry at this point in time because that will also have input into the interest rates and RBI action. But as even the regulator has clarified that it is not a worry at this point in time. And we also believe based on our inputs, based on our interaction with the companies, based on our own assessment of the input prices, that at this point in time, it is reasonably under control.
Okay. Kunal, on the charts though, for Marico, Dabur, Unilever, Nestle, etc., do you see any sectoral trend where you can sense that there is some fear around inflation and that's going to have a bearing on any of these staple names?
So, Aisha, these stocks in last 2 months, had gone through a correction. Now we've seen many of the large cap names like HUL, Nestle, Britannia also, I think if I'm not wrong, these stocks struggling to break even, their 200 moving averages. In fact, the last 2 months, 3 months in the correction, these stocks have gone through a 15-20% correction, which is not a normal tone of, the market because, we've seen that all the sectors have managed to chug along very well in this market trend. So, these stocks have, or these sectors have gone through best time-wise correction. But it was, a bit of a different reaction, which you saw where, these stocks corrected and went, significantly below their longer-term averages. But the last 3-4 days, because of this heightened, volatility which has come back into the markets, we've seen that, these FMCG names have somehow the fall has been arrested. These stocks are now trying to respect their support levels. You see some contra buying which happens into these names. HUL did pretty well in the last, or the previous, the last 2 days of the previous week. Nestle is doing pretty well. I think the stock is up almost 900 or 1,000 points from its, 1 week low, if I'm not wrong. In Marico as well is going through a bit of a reversal process, trying to hold up the support of 395, 400. So in effect, these stocks are now trying to shield their support levels, but it's not resulted into a strong wave of buying in the markets because that flavor of risk on is still there somehow in the mid caps as well. So I think till the time the market sentiment doesn't get shifted completely towards defensives, I think it's going to be a bit of a lackluster and very stock specific move from the FMCG pack. And to try and call in for a full blown reversal for the FMCG stocks, at least in the very near term, given the kind of evidences we've seen on charts, could be a bit premature.
Now you've definitely got that pull back or bounce back that's very evident in the markets as we're back above 15K. BEML shining 20% there. You've got ITDC, Just Dial, IOB, Jain Irrigation as well as Bank of Maharashtra. Vikas, the government has been full throttle with its intent to privatize, looking at, meeting the divestment target. BEML, the latest candidate, news reports floating around that a lot of auto companies are potentially in the fray. And there have previously been quite a number of companies as well that have been discussed. What's your sense? Are you comfortable when it comes to this privatization theme, betting on some of these PSU stocks, or is it a sector you'd prefer to steer clear from?
Like I commented a while ago that this time around intent of the government seems to be very well in place. They are looking to divest seriously, and so to that extent it's positive. And probably once few divestments are done, markets' faith for rest of the pack will also go up. So to that extent, I think looking positive. But from our standpoint of view, we do not do much of PSU investing. We have a small sort of opportunistic basket where we can end up doing that. But otherwise, structurally, we don't invest unless the hands have changed and we believe the new management is putting the business into a new growth trajectory and we are convinced about the future outlook of that company under the new management. At that point in time, we take the call and discuss. And otherwise, just we tend to avoid PSU as a basket.
All right, Vikas, we'll let you go then, and Kunal as well. Thanks so much for sharing with us your outlook on the chart patterns.